So now it's an 11th hour dash for cash at CIT Group, but does it really matter? Well, let's bring in someone who knows a thing or two about credit. Josh Rosner, he's the managing director at Graham Fisher & Company. Josh, good to have you with us. Thanks for having me. For coming in. Okay, so we all been watching what's happening with CIT. You and I were talking earlier today. You said it kind of doesn't matter because they're not doing a lot of lending anyway.
Well, that's right. I mean, the piece of their business that actually does matter is the factoring business, and it looks like there's going to be a buyer for that business. There's opportunities in that business. Small business needs to roll. The rest of the business, the small business lending that they have, at the end of the day, they've been reducing their exposures. They've been reducing lines for the past 6 months. They've really been pulling back from the market. They're not really a viable company going forward anyway. So even if we gave them some sort of interim or bridge funding, given what's going on in their credit quality, within 12 months we'd be right back to where we are. There's plenty of bandwidth for small business lending in the industry. No one wants to make loans at rates that actually the market's demanding.
Yeah, well, the rates are too high, according to a lot in the small business and medium-sized business segment. But no, let me just step back just for a second, because, we talk about CIT. They had the conversations supposedly with the government, with the FDIC, with Sheila Bair, Timothy Geithner at the Treasury. Is there is there like a weird standard here? I mean, it's not like we even do the gold standard anymore. This is a double standard, right? I mean, AIG, what happened? That was a bailout.
Well,
why is CIT different?
Because I think CIT clearly isn't a systemic risk. And I think that, there was a pitch to try and argue that, we'll bail out Wall Street, but we won't bail out Main Street. And I don't think that's the argument or the issue here. At the end of the day, CIT is not large enough, is not interconnected enough to be a systemic risk. There are other players. There's plenty of regional bank capacity for small business lending. That is the bread and butter of that business. And I think the argument or the question was put to them, if you believe that you're a systemic risk, convince us. And I think at the end of the day, we did see the Fed and the FDIC bend over to try and give them a 23A waiver so that they would end up with collateral that they could post to the Fed for money. But I would suspect that the reason that broke down is the quality of the assets that they were able to pledge was probably dubious.
You said just a second, you said about regional banks, that they could step in and then they could provide a lot of this lending capacity.
But they're not. We're actually watching, and it says, as you and I have talked, this has been one of my great concerns for the past several months, is the next leg down in this crisis, is that lending for small businesses is being shut down. As you talk to examiners, as you talk to small businesses, as you talk to regional banks, what you find is that even good credits are actually seeing their committed but undrawn lines shut. And as that happens, we're going to have more and more small and medium-sized businesses have to actually fund at the shorter end of the curve, which is going to create real further roll risk going forward. On top of that, remember, we've been operating in a low-rate environment for a decade, and there's not a lot of businesses that probably can transition to be profitable in a higher-rate environment.
Give a little bit of an explainer about when you talk about everyone crowding at the short end of the curve. This just means that because this funding isn't available for whether it's a year or 3 years or whatever it is, what are we going to do? We're going to have businesses starting to get, 30-day lines of credit?
Well, it certainly gets a little bit scary. It starts feeling like, or making you think of the risk of us becoming...
How do you run an economy on a 30-day line of credit?
Right. Well, how do you run an advanced economy on a 30-day line of credit? And I think that is the real question to ask. And the risk of that ends up being that we end up seeing a significant increase in small business failure. Now, think about 50% of total employment is at companies of less than 500 employees. 44% of total payroll in this country is companies with less than 500 employees. It's a little too late for the administration even to act on that in an effective way. Small business lending is actually down about 30% year over year through SBA and requires personal guarantees for the most part. So there's going to be a push to blow the SBA up, make it as bad a program as the FHA, which is high losses. There'll be more losses.
Then maybe you get a new government agency to come in and save it.